Good Wednesday morning, Market Chameleons, and everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamanik. How you doing, D?
Hey, Will, you sound a little bit like staticky to me.
Let me know if I sound staticky, how Dimitri sounds.
Yep. Good.
You want to start with the disclaimer?
Yeah. Good morning, everyone. Before we get started, keep in mind, Will and I in Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And I'm going to share my screen. As I'm doing that, as a quick note, anybody joining us for the first time, Will and I, we do this show in the morning to try to help answer questions you have about the Market Chameleon tools, the data, analytics. If you have a question, type it into the live chat on YouTube. Will's watching it, he'll read it back to me. If you want to ask your question live, we also provide a link to Zoom. Click on that link. It takes you over to Zoom. Once you're logged into Zoom, click on raise your hand. That signals to us that you're trying to ask us a question. Once we let you in, you could ask your question live, direct. While we're waiting for more people to join us and to give you guys a couple minutes to put in the questions, we'll start out looking at the pre-market report to see if we could get some insights, what's going on in the pre-market hours, and then we'll move on to the questions. Okay, so pre-market report. These are stocks trading in a pre-market hours. I'm going to come down here and we see a list of our most active stocks, biggest percentage gainers, biggest percentage decliners. See 78 stocks made our percentage gainers list, 31 on the decliners. So from this perspective, right now, it signals that there's more bullish bias in the pre-market trading. Let's look at it from another angle. I'm going to come up here. We have this calendar view, which is a summary of what's going on in the pre-market hours on that day. So today is September 27th. You can go back days to analyze the historicals, but today is September 27th. So we see 477 stocks are up, 172 stocks are down in the pre-market hours. As far as volume of shares, 129.8 million shares are trading on up volume versus 54.9 million shares trading on down volume. And if we convert those shares to dollar value, so not every stock is the same price. We have penny stocks, $50 stocks, $100 stocks. If we convert it to dollar value, we have $2.1 billion worth of stock trading higher versus 296 million dollars worth of stock trading lower. So this also indicates the trading so far in a pre-market has a bullish bias, right? Bullish sentiment. Let's do one more check. Then we're going to go to the questions, and I'm going to slide down here. And when we looked at this list, we noticed we have small cap stocks and their ETFs, leverage products, pretty much any security that's listed on a major US exchange. If it's trading in pre-market hours and it meets our liquidity thresholds that we set, it could make this list. So to narrow down to a small group of stocks, we could use the filters here above. This one you could use if you created your own watch list and you want to see what's going on in the stocks that are in your watch list. You could use this filter, just drop it down, select it. If you want to, we're going to use this one in ETF as an example today. So when you click on this filter, this gives you a list of ETFs to select from. When you choose one, we'll do this one, SPY. The list below will get filtered by stocks that are holdings in the SPY ETF. And here we see 13 stocks made our percentage gainers list, 3 on our decliners. So from this perspective, we also confirmed that there is a bullish sentiment in the trading in the pre-market hours. So we gave it a couple minutes, Will. We did have a question, an interesting one from Rob about oil prices. I could start with that one, unless you have other questions.
Yeah, we did have other questions, but you can certainly start with that.
All right, so let's start with that one quickly, and then I'll take the other questions. And there's an interesting article and observation, that I'm going to go here to Yahoo Finance and show you guys where crude oil is. So up 2%, and we could see that it's been steadily, kind of slowly climbing here, and I think even at this level, we might have hit a new high maybe for last 52 weeks. And the article, I'm not going to go into the article. We're just going to talk about the premise. The article makes a compelling case that oil prices will continue to rise because of low inventory, high demand, and it's going to continue to put pressure to the upside in this space. So if we take that premise, right, that oil prices are going to continue to go higher, and they might even spike to a very, much higher level, above 100. The question was, well, are there different ways to use options to play that outlook, right? And the first one was, well, taking a look at XLE, the energy sector, right? We could take a look at it. And I think from the perspective of oil prices breaching certain levels and doing sometimes they call it like a super spike, or they just breach certain levels where there's just way too much demand that outstrips the supply, because right now I think a couple things are happening on the supply side, where it's becoming more expensive to store it. We already have a dwindling supply, and then the war with Russia, that's taking supply off the market. And if we see that oil prices do, make this spike, right? Because oil prices could spike. We've seen it historically where they could just spike up really quickly to new levels. How do we play that? How do we hedge that? So one of the questions was, well, if we look at the XLE, and what we're really looking at then is, if that happens, what does the tail risk look like right now? Right. So it's not so much the volatility, we're not looking at the volatility or gradual move, but what does the tail risk look to the upside? Right. Do these stocks all jump with the oil prices? So we could take a look here and look under volatility, under risk premiums. And these risk premiums, they benchmark the options based on constant days to maturity. So we got 30 days out, 60 days, 90 days, and 120 days. So let's look at a little bit of a longer horizon, about 120 days, just because we don't know, it could happen next week, maybe a month from now, a little bit further. So let's go out a little bit further out to see what the markets are indicating, where they're pricing the tail. And what we're interested is in the upside. So we're going to look at the calls, the call premiums, right? Instead of the downside, we're going to look at the call premiums to the upside to see how do those premiums, right, on the wings compare to historical levels. Are they, indicating more risk? Are they complacent? Are they just ignoring this? Or are they just saying, that oil prices will come back down, for whatever reason? And here we see that currently, I'm just looking at the 10% out of the money, right? So this would be a call that you're buying, strike 10% out of the money, 120 days out, what is the premium for that call, right? And right now it is 1.34% of the stock price. Okay, so that's the premium. If we are converting the dollar amount that you're paying and making it a relative value relative to where the stock is right now, it's 1.34%, right? And if we compare that to where the average was in the last 52 weeks, we see that the average was 2.63%, and this is the high and low, 0.96, 5.74. So if we were going to take that outlook, and we disagree with the markets here, where we're like, well, we think that tail risk is increasing as stock, as this goes up, right? As this goes up, it becomes, riskier and riskier that we just run away, right? That it just breaches, any kind of resistance and goes. So far, the markets are not reflecting a risk like that. They're basically saying right now that, and nobody knows 120 days out, there's no way of knowing what's going to happen, right? It's not like that there's a definite answer to this, because anything could happen, right? Anything between now and 120 days could happen that could impact oil prices. But the markets look like, at least from this perspective, that they're pretty complacent, selling those upside calls. You could see we're on the low end of the year. But what if we played it a different way? Maybe higher oil prices, for whatever reason, don't translate to higher stock prices in the XLE, right? Like maybe they already are up there. Maybe the stock prices are already reflected of it. So the question was there a different way to play it? And you could form different outlooks or thesis based on higher oil prices, right? So as long as it's logical, like the thesis has to be logical, right? So we could say, look, higher oil prices, number one, it's going to, certain companies, right? For certain companies, it's going to lead to higher input prices, right? No matter, like they're going to have to pay higher, prices for their products. Okay, no matter whatever they're selling. So it's a big input price. Also, there are companies that rely heavily on consumers, and if people are paying more at the pump, more, to fill up their gas tank, that's less money that they have to spend on other stuff. So let's just say like something like Target, right?
Yeah, it can become a political issue.
Right?
I mean, we're a year away where they were talking about record windfall profit taxes in Europe, right? And going after the oil companies.
Right. So maybe the oil companies might not be the right play, just because of like what we were talking about, where they're going to come in and tax those profits anyway. So even if the oil companies are making more on their sales, that might not spill over to the shareholders. It might just go straight to the government, because the government's view is that the companies are at fault for it. So,
well, there's also a headwind just to begin with. They're trying to move away from fossil. When I say the government policies are trying to move society away from fossil fuels, right?
Yeah,
which it's a headwind for all these companies.
Right. So we might not be able to hedge that way, right? Or that hedge, right? That hedge may not work out even if oil prices go up, right?
Yeah,
So
oil prices can continue up and the XLE can,
not go
move
anywhere.
in the other direction or
That
stay still.
right, right. Which, in my view, if that happens, like, it's going to accelerate oil prices, because you would think if there's more profit, whenever there are higher margins, more profit potential, the economy works in a way where then more capital gets allocated to producing that product, right? More investment, more capital is committed to producing that product to bring the margins down. Here, it's almost like if you do, start penalizing, you're discouraging long-term investment. So what happens is that you're going to produce less, right? You're going to produce less supply to meet that demand. It could accelerate the problem, but who knows? That's a thesis. So on the flip side, we have to think about it. Okay, how do we hedge ourselves for a super spike? Or if the oil prices do go up, what are the other relationships out there? Financial relationships that are going to get impacted that I could hedge myself, right? So that's how you have to start thinking. Where else can I hedge myself against this? And so I'm just putting out ideas there, right? This doesn't have to be the idea. It could be any the whole sector, or here could be similar stocks, like Walmart. Will Walmart get impacted? Like because Walmart, they import their products. They have to, there's their transportation costs and cost to produce them, and then they have to sell it to the consumer, the end user, whose also disposable income is going down. Is that going to impact that business, right? We have to kind of make that decision. And when we is this one way to hedge? So now you're hedging, you're buying a put potentially for two things. One is that if there's a recession, and if there's just a recession, unemployment goes up, the Fed slows it down this way, then you're hedging yourself also, because that's going to impact these companies. Or if there's a super spike in oil prices and we stay up there, what if, I don't know, what if we go to 120, right? What if oil prices are at 120 and they stay there for an extended period of time? If that's the thought process, we have to start looking at where's the best ways we could hedge. Like, is the tail risk of that happening priced into these stocks? And if we believe that's a real risk, right, and it's not priced into the tail, then we might have an opportunity to, hedge ourselves at this time at a discounted price. Now, remember, when you're hedging, it's like insurance, right? It might not pay off, but you want to buy the insurance when it's cheap before something happens, right? That's the idea here. So let's go back to the risk premium here, and let's see if that's priced into like something like Target, right? So now we're going to go to the other side. Let's go 120 days out, and let's see where a 20% out of the money put, right? Let's say it really impacted. We could do 10%, 20%, but we see that the IB ranks here are moderate. So they started climbing up, maybe because the market's going up. But here, what does it cost to hedge, 10% down move? 2.4%. So that's, if we take the premium of the option and turn it into a relative value of the premium of the option relative to the stock price right now, it's 2.4%. And you could see that's below the average of the last 52 weeks. Here's the range, 1.43, 5.5. So I would say it's still on the lower end, right? The markets are not yet pricing in that if oil prices do spike how would everything else react? To me, it doesn't look like any type of, we're below the average, right? So if anything, they're pricing that out right now. 20% below. Here we got 0.75%. Here's the average of 1.29, and this is the range. So, if you just have to probably think about it logically, like what would, if oil prices do spike, it's a possibility because we just keep climbing, slowly up and up until maybe it just breaks that resistance. What would most likely be impacted, and how do I hedge myself? So, well, maybe I went too long with that because you did say you have other questions.
Yeah, we have other questions. I'll just put them on the table. You can either get to them today, or we could look at them tomorrow, however you want to do it.
Okay.
It was from Jackie. I got to go back in the chat for him. It's near the start of the day.
You could see
Jackie
I'm just like, it's already on the actually, like, if you compare it to the 52-week, maybe it's already reflected in the stock. I'd have to go look at the valuation or what's going on. I just kind of just picked one out of the blue that came into my head, so I don't know why it's like, already trading at a 52 low.
That's interesting.
Yeah.
Interesting. So Jackie was asking question: which MC tool, unusual option volume search versus option block search, is better for me to trade option by following smart money? Well, the first thing I can say is it's not a smart money machine, but
Yeah.
I mean, in my opinion, but I'll let you answer that.
Okay. Yeah, let me go to the option block trades. So how do I start this out? When people start to come in and try to trade, right? I think one of the things that they're I think too enthusiastic to do a trade. Okay, first of all, you shouldn't be doing a trade. Like for example, when Will and I started out and we were trained by, major Wall Street firm, we were not allowed to do trade for 10 months. 10 months we worked and they just trained us and we got educated. We were preparing, right? It wasn't like, what should I do and go in there? It's preparation. And I get this before I answer this question, because this question comes up a lot and it's a surprising question for like someone maybe like even me and Will, who went through a different training process. A lot of times.
Well, look, I mean, the one thing is there are people out there who promote, smart money machine. People are out there promoting on the internet, right? So if you're getting your basic option information from some people, they try to convince you that you can just follow some trade that's going on in the marketplace, right? And just piggyback it.
Yeah. And
because I've heard that smart money term before.
Yeah. And it's not even the smart. So the idea behind this is the following, right? That there's an easy way, right? Because what do people usually look for? An easy way, right? And there's no easy way to just sit there, look at something and just buy it and sell it. There's always this urge to say, okay, I just want the easy way. Show me the easy way. We're like, any easy way would have been already arbed away, right? Or it's not no longer easy, because whatever is easy, the smart people don't leave on the table, right? So Wall Street firms, hedge funds, anything that would be easy to do would have been already arbed away. You would not have a chance. They don't leave it dangling for you on the table. But the importance that I wanted to make here is that, I get this question a lot. I just need real time, a real time quote, and I'm going to decide what to do in real time, right? So on the spot, I'm just going to look at something and I'm going to decide on the spot what to do. Okay. Which is like you're forward testing your own thesis. And when you work in finance, 99% of what you do is with historical data. It's not with real-time data. It's always with historical. Because think of it this way. Why would I just jump on a trade having no idea what I'm doing when I could just go back even today, right? Even today, I could go back, in time and say like, well, you know what? My thesis is this trade happened, right? And my thesis is that this option will go up, and then test it, right? So and the SEC actually wrote a whole thing about this where they said that like amateurs, they are overconfident. So when you're overconfident in trading, what you miss out on is, did you evaluate your thesis? Do you have like some proof of even like that it could work? So forward testing is never a good idea. Like that, you would never be allowed to do that in a bank, right? You would have to go and prove your thesis and say, look, this is my thesis. This is, I saw, let's just say you have this thesis, right? A big trade, right? We could look at these big trades. We could filter them out. This is what we're giving you guys. We could go back days and look, right? And you could test out your thesis before doing anything, like why not first see how it pans out, right? Instead of just forward testing and going right straight into it. Because if you went into the bank and they would never let you do that, right? You'd have to like come up with your research. You'd have to come up with your, they'd ask you everything, like what is your risk? What is your win rate? What is your thesis? Why is all this? You have to come up, for yourself, so we could go in there and like, here, look at single leg trades. We could put in there, show me trades above 1 million. Here's big trades, right? Above 1 million, but look how many there are. 219. Are you going to do all of them? And how do they usually pan out? We could sit here and track them. You have all this data here. You could track, you could track how they actually performed, right? You could sit there, track it. You could put it in your watch list. And the idea is that, why do we use historical data? Because we always want to evaluate, we want to confirm, we want to quantify, we want to identify the risk, we want to know the dynamics before we even get into it. Because even after doing all that research and you think you have a high, positive expected value trade, right? Even after that, once you start trading, you're gonna start discovering things you didn't even see in your test, right? Like when you're doing out of sample, out of test, you're gonna start learning just from that alone, like it's not working the way I thought, and you're gonna start tweaking. So it's never a good idea to just put on a trade because you just see something and you're just overconfident, because now you have the ability, to go back. We could go back a couple of days if we wanted to. We could go back September 22nd, look for a specific type of trade, filter it out. We could look at a specific type of trade, let's say this LI, right? And we could see, okay, since that trade, what did it do to today? Where is it today? This is where it was at the time. This is where it is today. So you don't even, you could start confirming your suspicions. You could start confirming your thesis, before you commit any capital to it, because that's the way it's done, right? That's just the smarter way of doing it. So, when we use this is why the historical data is so important and it's so valuable, and if you look at you could go on the internet, and there are a lot of right now there are a lot of quants out there. There are a lot of people showing different types of strategies, but they're always looking at the historical data. They put it in their Python. They run their whatever return distributions. You have Markov chains, all this stuff. It's always done on the historical data, and that's like 99% of what trading is, right? You have to formulate a plan. Like, what is your plan? What is your strategy? And then what are your benchmarks that you're trying to meet? And what are the errors when you're actually doing it out of sample, out of test? So.
All right, D, that was awesome. I have 2 other questions. I'm going to email them to you. We can try them tomorrow. Jackie was asking, is a put call ratio important for stock and option trading? And where could I find it on the MC site? And Rob is asking, how does the pricing relate to the edge on calls or puts on this chart? So he was looking at the chart you were looking at, which he hadn't seen before. So he's very appreciative of you showing it. But I'll send those over. We can maybe do that tomorrow. Awesome job, my friend.
All right, everyone, thank you so much for the questions. They really help. Really appreciate it. Everyone have a great trading day. Stay safe out there, and we hope